Hey folks, welcome to this conversation. This is Business Redefined. As you might be knowing, banking season HY2026 numbers are rolling in, and the first kid on the block is always one SBM Bank Kenya. We're privileged to have the man in charge, my good friend, Bartesh. Welcome on set, sir.
Thank you, Julians.
Congrats on the HY numbers.
Thank you.
Maybe just give us a high-level view of how you feel about your income statement, your balance sheet, and your cash book as well.
Sure. So look, Julians, as you know, over the last 2 years, we've been rebuilding this bank. And what you're seeing now is just the results of that. So in the first half, we reported our PBT up 171%. Our balance sheet also supported that. Our deposits were up by 24% to 94 billion, which is a record for us as well.
Yeah.
And our loans were up by 18% as well. Again, to another record number as well. Our liquidity has improved. Our balance sheet in terms of capital has improved as well.
Yeah.
And our NPL ratios are down from about 34% to 17%.
Strong recoveries.
As well. Correct. So I think we've got everything, every major aspect of the business performing as it should in our strategy so far.
But Tesh, explain to me something.
Sure.
Come through your numbers and your liquidity ratio jumped at me. It looks to me like you're sitting on some extreme idle capacity, 46% thereabout. The statutory minimum is 20%. Why all that liquidity?
Sure. You know, I believe in a principle where you're taking stewardship of an organization and turning it around. First of all, is to make sure that you build up the capability before the capacity.
Okay.
Now, let me give you an analogy. If I was building a bridge today, I won't build a bridge and then figure out what capacity is going to go onto it, right?
Yes.
I'm going to figure out what load is going to go through it and build a bridge to that specification.
Absolutely.
So this is exactly that. I mean, liquidity is one aspect, but when you look at our capital position, when you look at our NPL, our whole balance sheet as such, right? We've restructured it to make sure that we give confidence to all the stakeholders, especially our customers, as we enable growth. So yes, our liquidity is very high at the moment, but that's not intentional to keep it there or to park it into government paper as well. We will deploy it into safe and sensible customer assets, but when the right ones come in.
I see. Safe and sensible customer assets. How does your origination look like? How does your pipeline look like?
So when I look at our pipeline across our three major segments, right, whether it's consumer, SME, or corporate, it's actually grown very well. I mean, you've seen our numbers, our customer loans went up by 18% in the quarter, which is the highest ever that we've achieved in terms of absolute numbers as well. So on the consumer segment, we continue to lend primarily on the checkoff side as well. And on the corporate side, we're supporting our existing customers and their ecosystem as well.
Yes.
So once you understand that ecosystem and you understand the risks within it, so we go not only for the primary anchor of the ecosystem, but all the people around that as well, which captures other corporates as well as the SMEs, which are part of that ecosystem as well.
Well, Bartesh, as you grow your loan book, and we certainly do celebrate that, it looks like you're not extracting as much as you could potentially from the NIM side, especially in your HY numbers. I thought you could have gorged on a little bit more on that side.
True, but I'll tell you something that would probably sound a bit controversial. I've been in the industry for 30 years, largely in Kenya, but I've worked outside as well. And I've always had this view that the margins in Kenya are too high. And that is
That's not a common statement from a banker.
It is. And I think they're too high. And I think basic economic theory, when margins are too high, they'll have to come, market forces will force you to come down anyway.
They're correct.
But if you look at what's happened, particularly with money market funds in the last 2 to 3 years, right?
Yeah.
They've exploded, right? And over time, more and more Kenyans will become accustomed to wanting to earn money on their idle cash.
Absolutely.
I mean, today, for example, all of you, most of us use M-Pesa anyway, right? You can go and park your money on a money market fund and take it out and pay at any time, right? But the days where you would have large amounts of CASA at 0%, I think are long gone for Kenya. And I want us to lead the way and be comfortable in operating in smaller margins, what I would call normalized margins as well. So I believe the margins where we are right now are the right ones. I mean, look, on the savings account, we provide 8.75% on 100,000 and above, right? So you don't need millions for that as well. But I'm comfortable with our margins, and I think that the margins in the industry will normalize as well. But I want us to lead the way in that.
Speaking about the margins, Bartesh, you've seen the evolution of the interest rate, the inflation environment. The 364-day is now ticking above the CBR. Do you see that compelling you to recalibrate how you look at the perspective on cheap deposits?
I mean, I've never looked at deposits as cheap, right? I look at deposits in terms of giving the savers a competitive rate, right? But coming back to your original question, I mean, look, the inflation that we're seeing right now, increase in inflation, is largely due to supply side effects, the effects of the Iran issue on oil prices affecting everything else, right? I think that the inflation rate at 6.4 right now is still well within the CBK's upper range of 7.5%, right?
Yeah.
Obviously, if it continues going up, then CBK will have to make decisions based on that at the moment. But at the moment, not too worried about that. I think the CBK have a good handle on the monetary policy. What a big worry is if, for example, what happened last year, if the T-bills run away too far from the CBR, then it's a problem for the country and the industry as well.
Yeah.
And I think the central bank has a handle on that as of right now anyway.
But if your asset quality is improving, but still your coverage is still ticking upwards in terms of provisions, is it abundance of caution in view of the risks you see materializing down the road?
Yeah. I mean, look, when you look at our NPL ratios last year, they were about 34%, right? And a large part of that is legacy, from the banks that SBM took over, being, certain assets and liabilities of Chase and Fidelity as well, right? And it's been our intention over the last 2 years to clean that up as well. So we've entered into negotiations with customers, getting out of court settlements and settling a lot of things as well. But we're also accelerating our provisions to make sure that we clean it up even faster as well. So it's a consequence of cleanup of the past rather than new provisions for the book underwritten in the last 2 years.
Okay. And do you see the credit risk environment in the market, currently speaking? Is it broadly improving? Is it stagnated? Are you seeing pressure points emerging?
What I'd say is that over the since the beginning of this year, it's been relatively stable, right? The big overhangs is obviously the non-payment of bills by both central and local government as well. That still continues. That's been the case for the last 2 years as well. But the pressure point that we're emerging and watching right now is the inflation uptick. If the inflation uptick results in higher interest rates, then we see the credit environment deteriorating quite materially as well. So that's something we're keeping an eye on. And particularly when we're underwriting new business, we're underwriting new business bearing that in mind, saying that should interest rates go up, would that entity or individual be able to sustain the repayments in a higher interest rate environment as well?
I see. How are you navigating the overhaul of the risk-based credit pricing regime?
So look, we've implemented it like all banks have done as well. And whenever the central bank moves the CBR up or down, we're ready to move that the very next day. So not an issue. The key issue comes in is the interpretation right now of the Supreme Court decision is that in order to move the K, we'd have to go to the CS for authority on that, right?
Section 44.
Section 44 on that. So that is something that is still an overhang, and KBA is obviously, the Kenya Bankers Association is discussing that and dealing with that in various ways as well. But that's an overhang that I see for the future.
Okay.
But as long as the monetary policy is stringent around the movement of the interbank rate and the T-bill rates around the CBR, we should be okay. But the moment you see a divergence, for example, last year when T-bills were at 17% and CBR was materially lower, that's when you start having problems in the industry.
I've asked the Bankers Association why it is that in their submissions they never sought a repeal of Section 44, but that's a question for them, not for you.
Yes.
Bartesh, your contingent liabilities are up significantly. What's happening there?
Oh, that's actually intentional. So as a background, one of our strategies was to diversify our income and to increase our non-funded income. So we've seen non-funded income go up in 3 main areas. In our cards business, in our transaction business as well. We've got more customers who are transacting more with us because of our stable systems, etc., and our trade finance.
Yes.
So we're really focused on our trade finance business, and it's 100% to do with our customers. So backing our customers and doing more business with them when they're importing raw materials to manufacture, etc. So it's been a
that's what's showing
specific,
up on the numbers.
that's what's showing up in the contingent liabilities. That's our LC business, basically.
I see. Yeah, because it really stuck out to me when I was combing through your digits. I'm pretty impressed by the trajectory you have in terms of efficiency and your cost-to-income ratio, but I'm worried about your staff costs and what we have seen in the HY numbers.
Yeah.
Do you see it beginning to erode the gains you have on the efficiency level?
Not at the moment, and I'll point to 2 things that I look at quite closely. The jaws, which is basically the rate at which my revenue is increasing compared to the costs, right? In half one, revenues increased at 3 times the level of costs. Because costs went up by 12%, revenues up by 36% on that. So as long as that's growing, we're okay.
You're okay.
But then also look at where is the cost growing. So the cost is growing in 2 main areas, staff and IT, right? We're investing in technology. We've upgraded all of our systems. And in staff, we've got now getting on the right people with the right skills to help us grow as well. You've seen that in the numbers. It's already delivering. But over the next few years, it'll add even a lot more to that. Okay. So yes, it has grown, but revenues are growing a lot faster than the costs.
So you maintain a good buffer?
We maintain a very good buffer.
In terms of the balance between your funded versus your non-funded income, granted you have mentioned that you're making progress in terms of strengthening the non-funded. Do you intend to push this further? Do you think you're now at a comfortable position?
No, I think, one of the philosophies that I have is that ultimately your non-funded income should cover your costs. So as long as our strategy leads us to a trajectory towards that as well, that would be the optimal position. We're still far away from that. Yeah. But I think with the progress that we're making, we're quite a far distance ahead as well.
Okay. On that. But in terms of your recoveries, would you say you're seeing a lot of strength coming from particular sectors, or is it cutting across the entire spectrum?
In terms of recoveries?
Yes.
So in terms of recoveries, I think what our strategy has been is, first of all, to talk to clients and see if we can get a settlement out of court. Unfortunately, our court processes take very long.
Absolutely.
And it's largely the lawyers that benefit from them rather than the customer or the bank on that as well. So in many cases, we've come to that agreement with customers as well and resolved quite a number of cases. There are others where we can't resolve it and we continue in court as well on that. And we're also aggressively increasing our provisions to cater for some of the historic and what I'd call legacy book as well.
I see. But just as we close our conversation, looking ahead, there's so much talk about the macro environment, how it's evolving and how it's impacting the operating landscape. As you look into H2, what are some of the thoughts shaping your mind?
I think H2, the one risk that I see is, increased oil prices having an effect on inflation, which would then ultimately have an effect on interest rates, right? But apart from that, when I look at the fundamentals, right, our currency is very stable, and I don't see that changing because the fundamentals support that, at least for the next 6 months as well. The political environment, obviously, we've got elections in August next year. As long as it doesn't get chaotic in terms of chaos on the streets, we don't see that as a big risk at the moment on that. But when I look at the fundamentals, when I speak to our customers, we actually see progress. We actually see a lot of hope and growth coming in the next 6 months from a macro perspective. On that.
One of the things which has recently been flagged by one of the rating agencies is what they call the banking exposure to sovereign debt, in terms of tapping onto government paper when it comes to deploying assets, when the credit risk is quite high outside here. How would you say you feel SBM is placed there?
No, I mean, when you look at our liquidity, as you rightly said, we have very high liquidity as well, but we're not parking that into government paper, right? We're going to park that or deploy that into sensible customer assets as well. From a sovereign risk point of view, I don't see a high risk with Kenya's sovereign risk, right? But for a bank, the only way you'll grow is if you deploy it in customers' businesses, and that's our strategy. Not to deploy it in sovereign risk, but in customer risk.
Okay. But let's close our conversation. We are in an environment that is consistently evolving, and there are opportunities being unlocked. You have had 2 years, and I can tell you from someone who has covered this bank, you can clearly see the turnaround. Having seen the legacy baggage, the restructuring you've had, the turnaround you're seeing in the numbers, what would you say is now shaping your next phase of execution here?
Look, for me, it's very clear, right? I mean, look, I'm not driven by quarterly numbers. Yes, our quarterly numbers are growing, but that's not what drives me, right? At the end of the day, what I look at it is that, look, you have a relatively short span of time to steward or take care of something that is going to outlive you as well. So you have to leave something a lot better than what you found it as well. So when you look at our people capacity, our balance sheet, our systems, everything's a lot better than 2 years ago. And we're investing a lot more in those areas over the next few years as well. So hopefully in a few years' time, when I'm long gone, people will say that it's a much better place than when I found it as well. So that essentially drives my philosophy.
Our last conversation was heavily on your digital franchise as a bank. How is the uptake going?
Oh, quite phenomenal. I mean, when I look at one of the key drivers of our NFI growth, it's been our transaction income, and that's driven by more customers transacting more with us because they've seen more features on our systems and our apps as well, and the stability of the system as well. I mean, for example, on our app, we're the only bank that has the level of digital services on our cards. No other bank has that in the market yet, right? The Busara, we're the only bank in Kenya, and I think Africa, that has that at the moment. So our digital, we're investing a lot more in digital, but it's also taking shape because customers are accepting it and using it a lot more as well.
Yeah. Bartesh, give us your parting shots.
Look, I think when you look at SBM, it's a different bank right now from where we've grown in the last 2 years. Very customer focused, we're very flexible, we make decisions quickly, and ultimately we just have one shareholder, which is listed on the Mauritian Stock Exchange.
Yes, the State Bank of Mauritius.
State Bank of Mauritius.
Yeah.
And it's a very different bank right now, and it's changing for the better.
All right. We've been having a conversation with the man in charge of SBM, that is Bartesh, unpacking the HY2026 numbers, focusing especially on the key metrics that we're looking at in terms of the liquidity ratio, the deployment, the balance of income streams, and how the second half of the year is likely to pan out. Keep it here for all the latest as far as the banking sector earnings are concerned.